Okay, so that's 3 o'clock here in the UK. Let's get going with the monthly webinar for INFINOX. My name is Richard Perry. I'm doing market webinars for INFINOX and doing the videos and analysis on the website. And hopefully, if you've been reading my stuff, you'll get a few of the themes that we're going to be talking about today. If we get into it, initially we're going to look at the risk warning because we're going to be talking about live market information today. So just understand that that is the case, and this webinar is for informational purposes only. So please bear that in mind. Now, what are we going to look at today? Well, just as an ongoing theme, what we're going to do with these webinars is we're going to look at the big macro picture, and then we're going to drill into a bit of Forex, bit of commodities, bit of indices. And what we'll do is at the end of the webinar, you'll have an opportunity to do question and answers. So if you've got any issues that are worrying you or issues that you need clearing up, please drop them into the Q&A box, and we will sift through them, and hopefully we can help you out with that. But yeah, Q&A session at the end of the presentation. But all throughout, I'm going to be talking about a load of different charts and looking at different trades that we could be featuring across the course of the next month. Okay, so first of all, what are the key factors that we're looking out for in May? Well, there's not actually too many central banks. The key central banks are actually at the end of April. So what we've got is we've got the ECB this week on Thursday, and then next week we've got the Federal Reserve. But into May, we haven't got a great deal going on. So in terms of what we're looking for from the ECB is that I think it's going to be a fairly steady as she goes type of monetary policy statement and press conference. They're not going to look to do too much, I don't think. Christine Lagarde has put her foot in it occasionally, but I think what she'll try and do is say as little as possible to just basically let the markets just go on as they are at the moment. Now, what they did last month was they front-loaded all their quantitative easing asset purchases in the PEP program to try and help to boost risk appetite and inflation processes and growth aspect as well of the recovery for COVID. And it seems to be that that is going to be a key feature, I think, moving into the next meeting, and there's going to be no real change of that policy. Looking forward to the Fed next week. That could be a little bit more interesting because markets have had a lot of opportunity to really move on the Federal Reserve. Noises that are starting to come through the Fed members that they're starting to think about tapering asset purchases. When that might happen, that would be the big question that I think is a feature throughout the next few meetings, is when they're going to start to scale back the asset purchases that they're engaging in. It's not going to be this month. April meeting is not a meeting where we've got any projections, and I think it's again going to be a fairly quiet meeting. I don't think we're going to get any real signal on tapering of asset purchases by the Federal Reserve until possibly, well, more than likely late summer. Probably the September meeting is when we get a real concrete indication of when that's going to happen. We may start to see some indication from the Fed members in their speeches, and they might start to talk about that. But obviously, individual Fed members talking about tapering asset purchases needs to be taken, or not with a pinch of salt, but just knowing that there's a whole committee to vote through the policy measure. So it will be an interesting move, I think, in the coming month. Maybe perhaps May is going to be seen to be something that the Fed members and their speeches are more interesting to look for. What we do have is also the Reserve Bank of Australia, Reserve Bank of New Zealand, and the Bank of England having their monetary policy updates in May. Now, the Reserve Bank of Australia is still fairly cautious, I might add. They even, in the minutes of the recent meeting, they actually suggested that they had the potential to increase asset purchases if they needed to. So Australia is still fairly cautious with regards to monetary policy, and raising of interest rates, according to them, is still not likely. Obviously, these things do change, but at the moment, not likely until 2024. So it's still a long way out before we start to see rate increases, and even the prospect of further increases in quantitative easing or asset purchases might be seen as well. So that may suggest that the Reserve Bank of Australia is going to be fairly neutral to possibly even slightly dovish, but they're obviously what we are seeing in global economy at the moment and individual economies around the world, especially the UK and the US, where the COVID vaccination program is going gangbusters. We're seeing the prospect of economic reopenings coming through the system. So that is obviously going to be a feature of the Australian one as well, whether that is going to factor into monetary policy. For the Reserve Bank, sorry, for the Bank of England, similar sort of story. What you do have is basically the prospect of negative interest rates is pretty much off the table now for the Bank of England. The crucial fact is how the Bank of England now start to put their message across that the economy is starting to get going again. It's way too early to start thinking about any sort of scaling back of interest rate, quantitative easing and interest rates. So I think that it's likely to be, again, fairly neutral, fairly steady as she goes. It is a super Thursday from the Bank of England in May, so that means you get the inflation report as well. And obviously with that, you get the growth figures and the inflation numbers as well for the projections. So they tend to be the more interesting aspects of that monetary policy update. Now, with regards to the COVID situation, obviously you've got two different contradictory factors at the moment. You've got the fact that several of the countries around the world, and some big countries such as India and Brazil, have really suffered amidst this surge of the variants of COVID, so subsequently infection rates have gone up, and obviously that's going to feed through into more lockdowns of the economies, and unfortunately deaths as well. But in terms of the economies getting into lockdown, that is the problem for the recovery possibly being sort of scaled back a little bit into the future. So for countries such as, obviously, as I said, Brazil and India, that's an issue, but also in the Eurozone as well. Now, in the Eurozone, what you do have is a ramping up of the vaccination program at the same time. So you've got rising COVID cases, but also rising vaccines. So at some stage, those two will, the rising vaccines will hopefully start to limit the rising of the COVID infection rates. And subsequently, we start to see the economies showing signs of reopening once more and scaling back the of the lockdown measures. And that will be the point at which we start to see, I think, a really decent move, I think, through Eurozone assets, possibly bond yields moving back higher, the euro getting stronger as well. Already we are starting to see the euro having signs of improvement, and I'll talk about the Forex side of that a little bit when I talk about the Forex markets. But certainly the COVID situation with the lockdown and the vaccine is a real sort of trade-off there, which one takes the influence, obviously hoping for the vaccines to win out in the end, and then subsequently the economies can start to reopen a bit and get the growth numbers going through again. We're also looking out for, I think, in May, the fiscal spending aspects as well. The two sides to this at the moment we're looking out for is what President Biden and the US administration are doing, and also what the EU Recovery Fund can do. The EU Recovery Fund is currently stuck in the German court system, German Constitutional Court has basically is sitting on a ruling at the moment, and whether it allows the EU Recovery Fund to start paying out its 750 billion euros will be one of the factors, because obviously these things need to be ratified across the 27 EU countries, and Germany obviously is one of those countries. So if the German Constitutional Court says no, that makes it really difficult for that get stuck in the courts, and eventually they'll say yes, presumably, but when is it going to happen? I think there'll be some news possibly in May about that. And obviously, as I said, the US spending side as well, where we're at in terms of additional fiscal support. Now, emergency fiscal measures have been put through. US citizens are sitting on, I think, $2,000 worth of stimulus checks that they've been given through this stimulus package of President Biden. They're talking also about more infrastructure spending and economic realignment. So how that plays out, could more news flow on that will be interesting to see whether that has an impact on stuff like bond yields in May as well. And just as a little interesting one as well, just keep an eye on this these tensions between Russia and the Ukraine. There is potential for this to boil over into conflict or serious conflict, and then you start getting NATO countries getting involved, and possibly the US, and that might have an impact on risk appetite. So that's something that I'm going to be keeping an eye on in May. Okay, so we have just sort of delved into the Fed speakers. So I think the speakers for the Federal Reserve and the ECB are going to be the important factors in May. Now the question is, do bond yields start to rise again? I don't like to talk about bond yields too much, because I know people sometimes get bogged down with looking at yields. But okay, so let's just have a look at this this 10-year Treasury yield, which has fallen back throughout April. And having had that rally or that rally in yields rolling over, that has now questioned whether we've started to see, I think, yields turning into more of a ranging market. And if that is the case, basically, bond yields have been a massive driver of Forex markets through 2021. So if bond yields start to go sideways, it basically means that we could start to see more ranging Forex markets. And what we have seen is that as these the 10-year yield has fallen away, we've also seen the dollar index falling away as well. And you can see that dollar index has fallen below a key level, 91.30, 91.25, 91.30 was a key moment, I think, for the dollar index. So the Treasury yields falling away has meant that the dollar index has fallen away as well. Now, if Treasury yields start to stabilize, and seen in signs in recent days that that could be the case, then we could subsequently see the dollar decline or dollar renewed sell-off just starting to turn into a range play. And I'm going to show you across a whole load of Forex charts, actually, that I think that that could be where we're coming towards in May. So ranging Treasury yields is ranging for Forex markets. But does that now, I mean, if Treasury yields move higher again, back through 1.77% on the 10-year and back towards 1.819, maybe 2%, then you're starting to see real signs, I think, that equity markets could be affected by that. So it'll be interesting to see how this plays out. But bond yields are a really important aspect for all markets, really. April data, April economic data. How does Q1 start to pan out for markets? Sorry, to pan out, because Q1 was obviously a lot of countries still in lockdown. Those lockdown restrictions, certainly for the US and the UK, have started to be eased now. So Q2 is now going to be seeing where we see that April data affected by that relieving of the restrictions on the lockdown. And if that starts to also come through the Eurozone as well, it'll be interesting to see how that plays out. But how the US and UK data compares to Eurozone data will be an interesting factor of April as well. Markets are expecting quite a significant bounce back. Certainly retail sales side would be a really interesting one, because obviously all these consumer facing sectors and companies had to close their doors throughout lockdowns. Well, they've reopened. The lockdown measures are eased. Social distancing is sort of a little bit less stringent, and we start to see really significant spending coming through these major economies again. Is that going to be shown through the April data is the question. And just going back as well, fiscal spending factors as well for the US and Eurozone. Okay, so on to Forex markets. I said about the dollar. The dollar is crucial for Forex major markets. How the dollar moves is just a massive factor, and it has been the key driver of Forex majors throughout 2021 so far. The dollar rally that we saw, get that back up. This dollar rally that we saw early January, it started to kick in, then really went in the late Feb into March. But it's completely and utterly been retracing now, and that's interesting because we've seen euro dollar climbing strongly higher, we've seen cable climbing strongly higher, we've seen dollar yen pulling sharply lower. So all these factors play into the fact that the dollar has been weakening. So that weakening dollar has certainly been a key factor for these major markets. And that dollar looks to be struggling, as I said, below that 91.30 on dollar index, below 91.30. I think that was a crucial moment, because up until then, you've got this recovery that had been playing out, this base pattern recovery, came back to basically the neckline breakout, went higher, and is now, I think, in breaking of that key higher low support at 91.30. That has changed. That has confirmed the changing outlook of the dollar. Dollar is no longer in a recovery phase. Now the question is, what phase is it in? I think you're going to see more of a choppy market moves in late April into May. The question is whether, if bond yields continue to fall away, then you're going to see the dollar under pressure to the downside. But I don't necessarily think that's going to be the case, because I still see that there is the expectation of economy reopenings that tends to be positive for treasury yields. So I think the dollar is going to start to take on a more of a ranging phase, and I think that means playing ranges in these Forex major markets is more of a likely scenario that plays out. Just because the dollar has broken below this support of 91.30, 91.25 on dollar index, that doesn't necessarily mean it's going to the lows. It means it possibly could be, but I think my feeling is that it's more likely that it means that the dollar recovery phase is now finished. We're likely to see more of a choppy phase. And I've said in my notes, and I've said in one of the reports I had on the website, that it's going to be important to see now how the dollar responds to a rebound, a technical rally that comes into this resistance zone now. Don't forget, old support becomes new resistance. So resistance of all these old lows, 91.30 up towards 92.15 is now resistance. So how the dollar reacts around that area would be really important. If the dollar starts to sort of stumble around that area, we could well see at the very least ranging and potentially renewed selling. But my expectation is that if the dollar gets back above 91.30, we could start to see more of a ranging play forming, and that could be a feature of May. So subsequently, I'd be looking across these majors and think, well, I like the euro above 120, and I'm going to talk about these charts in a bit on MT4. But again, look at the likes of. Okay, let me get the. find it. Sorry. Yes. Right, here we see that this is the my rebasing chart that I use, and you can see that all these lines going up from zero means that they're outperforming the dollar. Everything is now over the course of April, since the beginning of April, everything is outperforming the dollar. And just looking at the cluster at the top, the biggest performer actually is the Swiss franc. Now you'd think that if that was happening, that's Swiss franc is seen to be a really big safe haven play. Is that meaning that the markets are negative? Well, no, they haven't really been that negative. I mean, treasury yields falling would tend to come in a risk negative environment, but see in equity markets going gangbusters still. So that's not really the case at all, is it? You've also got this orange line, which is the yen. Again, that's performing very well, but equally, the dark blue line is the Kiwi dollar, the New Zealand dollar. What a rebound that's had. You've got the euro, which is sort of, I suppose, mid-range between on the risk scale. So euro doing well. Even sterling recovering from what was on the 9th of April, really big selling pressure, recovering about 2% since then. So the only one that's not really done anything is the Canadian dollar, which, yeah, whether that's surprising or not, I suppose you've had some choppy moves on oil, but Canadian dollar doesn't seem to be doing anything. So that maybe is one that maybe we sort of just leave aside. But looking at everything else, it's pretty much everything is performing well against the dollar. So you'd say that looking at these, maybe the fact that there's a lack of real standout performers, everything's really stuck in that same boat that maybe they're going to range if the dollar does start to range. And I think these pairs could all pretty much be that. So let's have a look at how the MT5 charts, and you can see that there's big strong rally on euro dollar as dollar index falls away. Now euro dollar takes, I think it's around 56% of the dollar index is the euro. So basically euro dollar is a flip of the dollar index chart. Now, so you've seen a sharp rally in euro dollar through the $1.20 mark. That was a big moment because that was a key lower high on euro dollar, and changing and moving through that resistance, and it had a sharp move through it yesterday, decisively so. That was a key outlook changing move because you can see it's trading now above all these the moving averages. You've got the RSI relative strength index momentum, which is pretty strong. And I think it's all set up now for, well, if you take it as a breakout, euro above $1.20 has the potential to go to 122. This purple area above here has the potential to go towards that in the coming weeks. My gut feel is that I still think we're going to see a bit of a pullback where, as I said, dollar index rebounds, and that would pull euro dollar lower. And I think that how euro dollar reacts around this support of yesterday's low, which is 119.40, how euro reacts around that could be a key moment. If euro starts to trade underneath that, then that would be a break of this recovery, and you start to see more of a choppy play. If you see euro holding above $1.20 in good style, I think we could well be on the way towards this 22 figure area. So how the euro reacts around in the next couple of days to what is likely to still be some sort of a pullback will be key. Holding above $1.20, I think we maintain that positive run higher, and then we start to look towards 122. And that could be your two scenarios there. If euro holds nicely above 120, you're looking at 122. And I think if euro breaks down below 119.40, closing below there on a confirmation basis, then you could start to see more of a choppy outlook again. But the fact that we've broken up through this resistance of 119.90, which was the reaction high, I think that now means that I think euros now at the very least is a range play, if not a recovery play towards 122. But as I said, how the euro responds, because as I said, just because it's broken through that breaking through that resistance at 119.90 for me means that euro is no longer corrective to the downside. I think it now has a more constructive, positive outlook, but it doesn't necessarily mean it's not going to come back and be more ranging. Because obviously, there's key moves that we are seeing at the moment that we may well see some sort of reaction back lower. Looking onto cable, sharp move higher on cable. You've actually accelerated higher on cable, but again, $1.40. Interestingly enough, has been the resistance. $1.40. Now, again, does this now mean we start to form more of a range play? Because you've got the support that comes in 36.50 area, 36.30, 36.50 up towards 37.50 area, but resistance again hitting at 130. A 140 big figure. Now, if you can't get through 140 big figure on a decisive closing basis, then I think you just turn into a choppy range play. But if you zoom out on cable, you can see that that's a pretty strong uptrend still in place. But the question is whether that dollar continues to fall, and if treasury yields fall away, you see the dollar falling away. I think you see sterling dollar moving higher, possibly to 142 area again. But as I said, if treasury yields start to sort of go ranging, then I think we're likely to see more of a ranging phase, and I think that could be where we're headed. So dollar yen, we had this sharp run higher on the dollar strengthening from the beginning of the year. Dollar really took off against dollar yen, and that basically is because dollar yen is really tightly knit to the 10-year treasury yield. And as I said, if you can remember that chart, and then we get the 10-year treasury yield up. Find it. You can see that basically from December, treasury yield really went off, and it's now started to fall back and went below that level of 159, or sorry, 1.59 the other day, which effectively equated to moving below 108.30, 108.35 on dollar yen. But if treasury yields start to move sideways, we could see dollar yen moving more choppy, more sideways. But the question is, how does dollar yen react, I think, in this resistance band now? Because old support becomes new resistance. 108.35 to 109.35 is the key area now, key question mark. And it had a dip back into it. If you zoom in here today, little move back into 108.35 area that's been sold off. So again, if it continues to consistently close below 108.35, we could well see dollar yen just trickling back towards the 107 mark. But if it then starts to reclaim 108.35 into this resistance band, then I think we could be more of a trading range. Looking at the Aussie, ranging on the Aussie, you could argue, I mean, I've zoomed in quite a long way actually. Just zoom out here. You could argue that it still has the potential to be a head and shoulders top pattern. That still could be that. And the fact that it's come back up, and you've got this resistance here overhead of this band, trading band between 78.20 towards 78.50 area, resistance there. It seems to be, doesn't it, that the Aussie could be stuck in a bit of a range. It has improved undoubtedly, and you look at the momentum picking up above 50 on the RSI. That's certainly an improvement, but is it really just turning into a range play? You're fairly choppy around these moving averages, and you've got other signals that you can point to. For example, not the stochastics, the MACD lines, which have been a little bit uneasy. Bit sort of when markets go into a ranging phase, if you're looking at moving average convergence, divergence, you'll see a lot of signals, a lot of false signals, and you'll see that these moving averages start to cross over quite a lot. And you got that, I think, on this chart basically since February. Aussie has been starting to range sideways, and hence why you're seeing a lot of false signals, arguably, on the moving average convergence divergence. So if you're looking at trending markets, moving average convergence divergence or MACD lines work very well. In ranging markets, a really bad indicator because they give a lot of false signals. So you need to make sure that if you're looking at a ranging market, MACD lines are not the indicator to look at. If you're in a ranging market, just to go back, then the relative strength index is a really good indicator to use, and you do the parameters probably between 35 and 65. So hitting 61 now on that RSI, just as we sort of come back towards the resistance area. So maybe not too much further to the upside. And the question is, can the Aussie dollar break out through 78.50 and then really start to trend again? Not sure at the moment whether it can. Right, there was one I was looking at, again, range play on the Kiwi dollar and then looking at Aussie yen. So let's get that back. Let's do Aussie yen first. Aussie yen, again, interesting that I would always look at Aussie yen as an indication of risk appetite and where broad market sentiment is looking across asset classes. And you can see Aussie yen had been trending higher. That trend higher has now turned into a range play. And I think you're going to see that it's going to continue to be like that. And again, as Treasury yields start to move sideways, I think that that's likely to be a continuation of that. And that for me is an indication that we are moving into more of a ranging phase on these markets, rather than the trending phase that we saw in late 2020 into 21, Q1 21. And let's look at the Kiwi. Again, sort of a recovery, really. It's unwound the oversold position on the RSI. It's, yeah, again, I don't really think that that's a market that you want to be sort of chasing too much, thinking that upside breaks are going to work. I think that this is going to move into a range phase, and just seeing the resistance that comes in sort of 72.70 area up towards 73.20 area, I would be a little bit wary of chasing that too much higher in these markets that, again, I think could start to turn into a range. Obviously, we have had that sharp run higher, but does that mean that we're going to continue to burst through all this resistance? There is quite a bulk of resistance actually to get through from January and February, and it'd be interesting to see if we can get the Kiwi through that. I'd be surprised at that. Again, be careful into May, because you do have an RBNZ policy meeting to consider as well. Right, so on to commodities now. Again, the weaker dollar has certainly helped to pull commodity prices higher. That is undoubted, and you can see that through the fact that gold has rallied, silver has rallied, and to an extent oil has rallied as well. But oil is certainly, obviously, has its own demand aspects as well and supply aspects, so it's difficult to lump them all in the same boat. However, gold and silver rallying quite strongly on that dollar, which has weakened. So let's show you the charts. You can see that pick up in the gold price in the past few weeks as the dollar has sold off. You've seen gold actually rallying through the resistance of 1765, which completes a small base pattern and a recovery. Is it a recovery that you really think is going to be going for considerable time? I think that, I mean, this is the recovery zone that I've drawn in from the potential base pattern, and you can see positive moves through the momentum indicators. However, as I said, if the dollar starts to range and treasury yields start to range, I think you're likely to see that gold starts to range as well. Now, what we can see is that this is the correlation between gold price and treasury yields, and at the moment it's very negative. It's turned very negative again as gold has picked up, treasury yields fell over. Interesting that that happened pretty much on the same day. And if treasury yields continue to fall, you can expect gold to continue to rise, would be the takeaway from that. However, if my hunch is correct and treasury yields do not continue to rise and they continue to fall, and they start to go sideways, then we're likely to see that rally struggling on gold to make too much further headway. However, technically speaking, you'd still want to be, I think, sorry, wrong way. You'd still want to be probably playing the recovery on gold. So you'd be looking at how gold responds in the 1755 to 1765 area. And in the last 2 days on the breakout, which was on Monday, you've seen that decisive breakout holding actually into the close. So some decent signs of support at 1765, which is encouraging for gold bulls for a recovery. But we need to see this traction continuing, and it's just stalled, you could argue, in the last couple of days with that slightly corrective candle that we had on Tuesday. Sorry, it's Tuesday today. When Monday. So that's gold that looking like that. Now I've gone back in the time frame to the middle of last year on silver, because you have seen silver picking up, but you can see here it's essentially just a massive trading range going sideways. So in trading ranges, you tend to see that false breakouts, resistance will quite often be seen, old levels as well, pivot lines coming in. So I'm a little bit concerned the fact that we've seen silver. So just zoom out a little bit around this resistance here. These old lows that came in late summer became resistance back in December, supportive in January, and has become resistance in March, then February, March. So subsequently, with the rally in April hitting that level, hitting that level of resistance and just starting to stall a bit, you've got these moving averages which are fairly flat. You've seen an uptick in the momentum that's improved, but yeah, again, this is a sign for me that I'm not entirely convinced about the recovery in silver going too far. It would need to get through this resistance line of this reaction high here, which comes in around 2665 area. It would need to get through that in order to really start to sort of open the upside, and then you start thinking about 2830 area. But for now, I'm seeing this as a fairly significant resistance overhead, and I'm not expecting it to go through that. Although, as I said, the RSI has picked up. Now, I did say that it was a trading range, didn't I? So if we look at the, sorry, not stochastics. Actually, let's look at stochastics first. Silver. Yeah, Bollinger Bands, pretty neutral, I'd say. Stochastics just turning over again, which might limit that, and the fact that we're at the limit of the Bollinger Band as well. Doesn't look as though it's about to start to trend higher on the stochastics and the Bollinger Bands, sorry. Silver on the MACD, just getting the prospect of another bull cross on the MACD lines, but what you do tend to see are these, yeah, there's just quite a lot of signals that are fairly mixed, I think, on the MACD lines. And again, that's indicative of a range play. You get these sort of crosses that are false signals. Well, that one worked fairly well. You didn't see that one working. Yeah, I wouldn't be looking at MACD on the silver trading range. Really, I'd be avoiding that. But little, I mean, there is a slightly positive near-term bias, certainly within the silver sort of pulling up from that 25.60 area basis of support, but you've got some significant resistance overhead. Okay, so with regards to oil, what we've had recently is the upgrading of expectations by the International Energy Agency, and the expectations of oil demand have been increased. So subsequently, that has helped to boost the price in recent days. And I wrote an article on the website about that. If you want to go and read about it, you can. Let's have a look at the oil price, and you can see that the move through the resistance, which basically oil was ranging, very choppy ranging actually, but moved through the resistance 65.50 the other day, middle of last week, and has continued to edge higher. Had I mean, the upside move, actually, the inference of breaking through this and regaining the upside initiative would suggest 69.50 towards $70 could be seen. I think as long as it holds above the 65.50 area, then you could well be still on for that. But today's reversal, intraday reversal, is not all that encouraging. If that closed here, it's a small shooting star, only a small one, but still a suggestion that an upside break has been rejected. So just be careful, I think, on oil with that. And so, yeah, I've sort of talked through those trades. Yeah, I've pretty much talked through those, so you got them there on the slide. And finally, on indices. Now, indices, really strong indices in March. Sorry, excuse me. Indices have been really strong throughout March, and what we've seen is that big run higher came across these markets. Now, what do I need to show? It's that. This one. Right, this is since the beginning of March. So throughout March, we've seen all these indices moving decisively higher. Look at that at the top. DAX, 8.7% up since the beginning of March. Really strong run. And you've seen, well, the S&P 500 doing well, the Dow doing well. At the bottom, you've got Nikkei. Obviously, you'd be wary about that. It doesn't really seem to do a great deal. Now, this is the comeback kid. In the last couple of weeks, as treasuries have fallen over, then the Nasdaq has really risen. Now, I've talked previously about the fact that bond yields soaring higher was negative for the Nasdaq, because that was turned investors off the zero yielding Nasdaq, which was really expensive in terms of the sort of jam-packed with growth stocks. So markets were turning away from growth stocks more towards value stocks, which are high yielding. So basically, you would prefer to see, in terms of value stocks, you buy them because not only have they got the potential for recovery, but also you get a good yield as well. So you get that double whammy from it. And subsequently, we saw the Nasdaq underperforming. But as treasury yields have fallen over, interestingly, the Nasdaq has started to really climb back higher again. Now, does that continue? Is the case that we need to know. Again, if treasury yields start to sort of hover, I think that the Nasdaq, well, if treasury yields start to rise again, Nasdaq comes under pressure. But also, looking at these equity markets, S&P 500, there are signs of exhaustion at the moment. Really strong run higher through March on the S&P 500. Look at that big rally. If I zoom out here, you can see that it's now rallied to the top, or actually through the top marginally, of what is an expanding uptrend channel. So the fact that it's rallied to the top and started to now find corrective outlook. Look at that RSI hitting 75 and is now started to fall quite sharply. Closed lower yesterday. If I zoom back in, it's down again today. Now the question is this a corrective move? This is the 4-hour chart. This is the chart I would be looking out for. And you're looking for how the market responds around key support lines. 4,110 was this reaction low here, 4112 actually, but 4112 was this reaction low. If you start to close below that, you start to form lower highs and lower lows. But already we're seeing the relative strength index, the RSI, decisively falling away. So we are starting to get this instance of lower highs and lower lows. It seems as though that 21 period moving average on the 4-hour chart, which was a really good basis of support throughout March, has now been decisively broken and could now start to roll over. So is this the beginning of a corrective move on the S&P 500? I mean, historically, it's really difficult to call top patterns and reversals on Wall Street because it's so massively skewed by quantitative easing money. However, technically, you'd certainly say if that goes back below 4,000, I mean, on this daily chart here, 4,100 seems to be a basis of support. If that gets broken, you really are, I think, into sort of near-term corrective territory, and then you come back into this sort of 3,960 to 3,980 area of sort of support, which were these old breakout highs, and you retrace back towards the that's the 55-day moving average. You'd be retracing back towards that. But even the 21 days at 4,050 at the moment. So the prospect of a near-term correction is certainly growing, but those supports, if they do get broken, then you could see that move hastened. But as I said, if it comes back towards sort of 3,960, 3,980, I am really looking at that as an opportunity for getting back in on the long side again. You'd start to look for support and renewed buying signals again around that sort of area. But what I'm actually doing at the moment is compiling a list of 5 top picks for equity buying opportunities in May, and we're going to be putting that through I think in a week or so, and it'll be interesting to see that part of that report, and I'm talking about the fact that obviously equities have been really strong, but I think we're due a correction. But I think that correction would be a buying opportunity, and there are opportunities that I have noticed, I think, in equity markets that are opportunities that can be taken in that corrective move. So S&P 500 pulling back. DAX, again, DAX is going to be an interesting one because, again, DAX has also shown signs of correction. 2 sharp moves to the downside. Zoom in a bit here, we can see better. Already DAX has unwound back into the support, not even breakout support, the downside support. It's showing signs of breaking that support, 15,165. It could easily be that the DAX comes back to 14.8, maybe 14.4. This 55-day moving average. If that 15,150 area of support is decisively breached, we could see a quickening because already that RSI is leading that move lower on the DAX, and that does not look all that great. That move downside on the DAX today, yeah, that looks like a pretty significant move. Again, if you decisively close below that, you could quickly come back into this support band you have here between 14.4 and 14.8 on the DAX. But again, that would be an area where I'd be looking out for buying opportunities, I think, and looking for support to start to build, and then buying opportunity signals coming through on indicators. And finally, again with FTSE, hitting resistance. This blue line here, if I go out here, 7,000. Cross there on it. 6960 up towards 7 area, 740. You can see the significance of these old lows back from 2019 actually, and have come in as resistance. And you've seen a sharp move to the downside today. Again, is this the start of a move that is a deeper correction? Again, you've got these breakout levels, 6,800, 67.85 area, breakout levels of support. If you see those broken, then you could quite quickly come back towards 6.6 area on FTSE 100. But this move to the downside today does look as though it's starting to threaten a bigger correction, because obviously the size of it that we've seen. Okay, so let's get that, and I think we're now open for any questions that that you guys have got. I'm very much open to answering your questions that you have. Any pairs that you're looking at, any instruments that you want a bit of technical analysis on and my opinion on, just drop it into the question and answer box. I've seen a question here from Thakar. I want to learn technical analysis. Okay, well, you're in the right place for finding out certainly my views with regards to how markets move on technical analysis, and I put quite a lot of detail into the reports that I write, which cover technicals, and we start to use some of those indicators that you'll be looking at, such as the relative strength index, which is my favorite momentum indicator. The moving average convergence divergence is something that I like as well. As I said to you today, that needs to be used, I think, in trending markets more than ranging markets. There you go. Good question, Dev. Which indicators to be used for day trading and scalping? Well, I know that in terms of day trading, because indicators for scalping are, I'm not even sure about whether I should be talking about scalping, but certainly for day trading, there are technical indicators that I use, a group of technical indicators that I use. Basically, price is fundamental. It's everything. Price is everything. If you see the price moving through supports and resistances, that will be happening for a reason. That is a shift. That gives a shift. It was a bit of a theme of what I was talking about with the dollar moving through 91.30 on the dollar index. Prices move through support levels because that suggests a change in sentiment on how a market is looking. So how prices move is really important for I think, for technical analysis, because all these indicators that you can look at, there are reams of indicators on MT4 and MT5 that you can be looking at. They basically are all measured off the price. So if you can get your head around the fact that you need to be analyzing price moves, that's all important. All these indicators sort of come as derivatives off the price move, and some are better than others. Some give confirmation, some give signals on momentum, on the speed of the price move, but essentially everything comes down to the price. So price is everything. You need to always look at how prices move, resistances, supports, trend lines, and then through that you get your pattern analysis as well, which is sort of secondary, but I think certainly support and resistance lines and trend lines are really important. If you can pick the trend in a market, then you'll know that you're on the right line, and as long as you're trading with the trend, that is in my opinion the most important thing, because one of the big things that I found early on in my career was that I was looking for reversal signals, thinking that there were reversal signals coming, and there weren't. And essentially, you get a lot of false signals around reversals. Markets move in trends, and the trends are the big factor for how I think price analysis should be taken. But from that, I also use moving averages for to help with trend analysis as well. Moving averages are good indicators for indicating trend, but also momentum as well. The relative strength index is one of my favorite indicators. I also do, as a secondary line of momentum indicators, I look at stochastics and MACD lines. If you're looking for trending markets, I like RSI and MACD. Stochastics are good in ranging markets, and MACD is not good in ranging markets though. So DevDat, I hope that has helped you, and Thakor as well. I hope that has helped you to get a bit of an indication of technical analysis there. Are there any more questions that anyone is interested in?
All right, Richard, there was one question I just answered, but I thought it would be worth just going over it. It was just from NSEF about where we can find your reports. So.
Yeah, the reports are, if I get the website, I'm not sure about .com, whether it's any different, but I know that IX Intel is where the reports are, and then if you click on the research section, then all these the reports that I'm writing now, and here's the report that I did today. You've got Forex, Commodities, market news section as well. So all the reports I write throughout the week are in this section here on the IX Intel tab on the website. Right, are there any other questions or instruments you want to have quickly done that anyone's trading? Any interesting thoughts that people are having that you want me to have an opinion on? Just quickly ask in the question and answer box, but we're sort of coming quite close to the end. So okay, again from DevDat, how do you do fundamental analysis? Again, a good question, a very broad reaching topic, fundamental analysis. And now fundamental analysis obviously takes into all consideration about big picture economies, macroeconomic issues such as interest rates, such as inflation, such as unemployment, all different factors that feed into monetary policy for the countries, and then monetary policy is the key driver to how currencies move. So relative monetary policies around the world are really important. They are depicted through bond yields. So basically monetary policy is shown through how bond yields are moving, and then from that you get currency moves that really take hold. Okay, so I'll be honest with you, Seth. I don't have any books that I would specifically point to for beginners on fundamental analysis, if that's the case. There are obviously on the internet you'll be able to find some good books, I think, for beginners on fundamental analysis. But yeah, I mean, it's because it's such a big topic that it's a difficult one to really pinpoint on one specific book. My opinion on EuroCAD very quickly. Yes, no problem. Let's give that a go. So I've got chart here, EuroCAD. I've got to find it. Oh no. I actually do have to find it, which is annoying. Okay. Symbols. Euro CAD. There you go. Wow, what a move that has been. As I said to you earlier, I mean that chart that I showed earlier was that Canadian dollar is basically going sideways, doing very little, and euro is rallying. So subsequently, what we see is euro CAD sharply higher, and it's almost at the moment the same chart as the recovery that we've seen on euro dollar. Interestingly enough, so you've seen, if I zoom in here, you've got this breakout and the move, which has left a nice line of pivot support, 149.50 up towards 149.85. Great line of support that, and it's even broken out again in the last couple of days above 150.40. So any sort of unwind towards that looks to be probably certainly a near-term buying opportunity with the strength of the momentum. Certainly looks as though that run is going higher. You've got the resistance coming in at 52 figure area next, so that could easily be the path of least resistance towards that level, 52 big figure, 152 big figure on Euro CAD. So further upside certainly looks due. Be seeing a recovery uptrend. So you'd be thinking that would be an uptrend you'd want to hold on to in if there was a near-term slip back, and I would be looking at this and thinking, well, there's a decent breakout line of support there around 150.30 area, and that would coincide with the uptrend in the next couple of days. So I would be looking at and thinking, well, I'd want, if I'm playing that on the long side, that's broken out and it looks very strong. You've got the 4-hour chart again, a little slip back towards that. You do have this run higher here that was similar, that took the RSI on the 4-hour chart up into the high 70s. So the fact that you're above 70 is not necessarily restrictive, but you've got a good line of support there. 150.52 area, 150.50. Got that uptrend coming in there, so it does look positive certainly, and it's running higher. You've got the momentum behind the move, and I think 152 big figure on this daily chart is where the next real resistance starts to come in. So you could quite easily see that being your target area for the next potential area, and 152 figure up towards 152.75 area could easily be seen. I hope you found that helpful, Bright. Okay. So unless there's anything else, I will wish you good luck in your trading. Yeah, join me again in May. We've got another webinar. We're doing these monthlies now, and I hope you find them interesting. And they do help you with what you're looking at. Yeah, we'll be doing it again next month. So join us again then. With that, I will leave you with the disclaimer, and we'll speak to you next time. Thank you very much.